Hey team, it's Matt from Universal CPA Review. So if you're studying for the CPA exam, or you're an accounting student, or you're just trying to do your job at your company, this video is for you. What we're going to do is walk through a simulation from the Universal platform that shows you how to consolidate financial statements. Now in this situation, we have an acquired subsidiary, and then a whole year later, we need to actually prepare the consolidated balance sheet and income statement. But guess what? The aspect of non-controlling interest exists in this simulation, so it gets even harder. So this is a great video. Now, real quick before we dive into it, please subscribe to our YouTube channel. If you haven't yet signed up for a free trial, please do so on the Universal course. You can join our Facebook or Reddit study groups. Those are very helpful. And then lastly, if you have any questions about your CPA journey, any discounts we're currently running, please reach out to us. You can find our contact information on our website. So are we ready to go? This video will walk you through how to prepare the consolidation of Coral and its subsidiary. Now you've learned about the acquisition method and how to eliminate an acquired subsidiary. You've learned about intercompany transactions, and now it's time to understand how to pull together and prepare the consolidated statements for the parent company, which is Coral here, and its subsidiary. Now, this is a very difficult simulation because we will have to prepare a consolidated balance sheet and income statement to answer the simulation. So before we get started, well, we're going to read through the instructions, and then we're going to review the exhibits so that we know what information we have, and then we'll prepare the consolidated balance sheet and income statement. And at the very end, we'll go through and answer the simulation rows, right? So strap in because this is a very important topic and it's going to be difficult, but by the end of it, you'll be a master of this topic. So here are the instructions for this simulation. And the first sentence tells us right off the bat that on January 1st, year 5, Coral acquired controlling interest in Sand, right? So Coral is going to be the parent company here. Sand is the subsidiary. Controlling interest means they own more than 50%. We don't know if that's 100%, and if it's less than 100%, that means non-controlling interest will exist, and we know that's a tricky topic. It then tells us why Coral acquired Sand, but we don't really care about that. Ultimately, we will need to prepare the consolidated financial statements of Coral and its subsidiary to complete the task in column A. So there are 5 exhibits in this simulation. One of them is the financial statements for both Coral and Sand for year 5. So we'll need to reference those. We'll flip through the exhibits here in a second. But some additional information that we do need to keep at the top of our mind, right, is that there's no change in fair value of the assets or liabilities for Sand from the acquisition date to the end of the year, right? So that's going to be important. I'll bring it back up when it is time to make sure we understand that. And then it also says that Sandcorp paid dividends of $10,000 in year 5, right? So that is also going to be relevant, especially when we have to go ahead and calculate non-controlling interest. So the 2 most important exhibits are going to be the unconsolidated income statement and balance sheet for year 5 for both Coral and Sand, right? So as we can see on the left, the income statement, it's by entity, it's not consolidated yet, and this is for January 1st, year 5 to December 31st, year 5, right? So it's the entire year. And then for the balance sheet, it's as of December 31st, year 5, right? And again, that is unconsolidated, so it's for Coral and Sand, right? So we're going to have to use those as our starting point in the consolidation. So this next exhibit is an email from the CFO regarding the Sand acquisition. Right, so in the second sentence there, it tells us they acquired 75%, right? So that's controlling interest, but it's not 100%. So that means that 25% relates to non-controlling interest or minority interest, right? And they paid $300,000 for that 75%. So that means overall, right, that Sand has a fair value of $400,000. So that $300,000 is for 75%. Non-controlling interest would have $100,000. Now it also says that they use the equity method to record this investment, and there's the journal entry that they booked on January 1st of year 5. The other important piece of information is that they used Goodman Thomas to do the valuation work, and we're given the valuation report, right? And this would have been when they assessed the fair value of all the assets and liabilities. Because remember, we bring the assets and liabilities onto the consolidated financial statements at fair value and not necessarily the book value that they were when Sand owned it, right? So that fair value report, it's another exhibit. And as we can see, well, everything's the same except for inventory. Inventory was $20,000 higher in terms of fair value, right? So that's going to be relevant when we do our acquisition method entry at the end of the year. And remember in the instructions where it says there was no change in fair value, well, remember this is as of January 1st, year 5. We're going to be bringing on the fair value of the assets and liabilities at the end of the year, and there was no change, right? So that's how we know we can use the same numbers. This next exhibit is regarding Goodwill Impairment. And remember that we have to record goodwill on the date of the acquisition. And then at the end of the year, well, the company and its external auditors would assess whether there's any impairment, right? So it says that as of the acquisition date, goodwill was $210,000. There is no impairment here according to the accounting team and the external auditors. So at the end of the year, goodwill will be $210,000 on the balance sheet, right? So we'll bring that back up when we need to. Now, this last exhibit is a memo related to intercompany transactions that occurred during year 5. Because remember, now that Coral acquired Sand, they're a consolidated subsidiary, so any intercompany activity does need to be eliminated. And remember, Coral, they acquired Sand to expand. And it says that they basically wanted to gain access to existing customers of Sand. And so what Coral did is they transferred inventory with a cost of $50,000 to Sand at a 20% markup. Now, ultimately, all of that inventory was sold during year 5 to third parties, right? So we will need to prepare an elimination entry to eliminate this intercompany activity between Coral and Sand, right? And this is purely in the income statement because there is no remaining inventory at the end of the year, right? So when we get to preparing the consolidated income statement, we'll go through the elimination entry for this intercompany activity. So let's start with preparing the consolidated balance sheet, right? So remember the exhibit that had the balance sheet by entity? Well, there it is. On the left, I've brought up the beginning of our consolidated balance sheet, and we'll move left to right as we go ahead and prepare this, right? So I just wanted to make sure you understand where the balance sheet information on the left came from, and then we'll add in basically this next column that combines these two balance sheets, right? So it's as simple as just adding Coral plus Sand. Now we know that's not going to be the final result, but we will need to combine those before we go ahead and do any elimination entries, right? So that is on a combined basis, basically just adding them together. So when we think about what eliminations we'll have to make, well, we're going to have to eliminate the acquired subsidiary, and we'll use the 6-step acquisition method approach. And then when we think about, is there any intercompany activity? Well, the answer is no. Remember, all the inventory was sold, so we don't need to make any balance sheet adjustments for that inventory that was transferred from Coral to Sand. So on the right is our 6-step approach for the acquisition method, right? And normally we would record this journal entry at the time of acquisition, but we could also do it at the end of the year, right? And most everything's going to be the same except the investment will be a different amount at the end of the year versus the beginning of the year, as well as non-controlling interest, right? So on the right is our 6-step approach for the acquisition method. This will help us understand the journal entry that would need to be recorded, and ultimately this will become the elimination entry in our balance sheet, right? So the first step is to eliminate that investment in Sand. And we can see from our balance sheet that the amount is $360,000. Well, under the equity method, a company would increase or decrease their investment in that company based on the share of net income or loss or any dividends paid, right? So what we need to do is go ahead and understand how to roll forward that initial investment of $300,000 to the $360,000 at the end of the year. Well, remember, SAN, if we look at that unconsolidated income statement, they had $90,000 in net income. And then in the instructions for the simulation, it said that they paid or issued dividends of $10,000 during year 5, right? So the question is, what's the impact of both Coral, and we're actually going to attack the non-controlling interest at the same time, right? So as you can see in this visual here, on the top, we're going to allocate net income, right? So Sand year 5 net income was $90,000. So for Coral's ownership of 75%, that means their share of net income was $67,500. And then for dividends, well, it's 10,000 times 75%, and that means their share of dividends was 7,500. So here's our roll forward of the Sand investment. So on the acquisition date, they would have recorded $300,000, but then they had to increase it for their share of net income, which was $67,500, but then their share of dividends would have decreased it for $7,500, right? So that's how we got to the investment at year end, which was on the balance sheet of $360,000. So for non-controlling interest, the process is the same for determining the share of net income and the share of dividends, right? So we can see that the share of net income for non-controlling interest was $22,500 based on their 25% ownership. And then for dividends, it would have been $2,500. So when we prepare the roll forward of NCI, well, it's the same idea. Now the beginning, at the acquisition date, the beginning balance of $100,000, how did we get that? Well, if Sand purchased 75% for $300,000, that means that the total fair value is $400,000. So 25% of $400,000 is $100,000. And then we increase it for the share of net income by $22,500, decrease it by $2,500 for the dividends. And that means the NCI at the end of the year is $120,000. So going back to our 6-step approach for the acquisition method, we now understand why the credit for the investment in Sand, our step 1 is $360,000. And then for step 2, our credit for non-controlling interest is $120,000, right? So hopefully we understand how we get that. And once we're done with this, I'll show you how to plug it into our balance sheet consolidation schedule. So let's move to step 3, and this is where we need to eliminate the book value of net identifiable assets for that acquired subsidiary, right? And so that's basically just the stockholders' equity for Sand. And we can see there, it totals to $250,000. We've got the common stock for $40,000, the additional paid-in capital for $10,000, and the retained earnings for $200,000, right? So that's how we get to the $250,000. And in our eliminations, that will all be reversed out so that all we're left with is the Coral stockholders' equity, which becomes the stockholders' equity for the consolidated balance sheet, right? So we'll get to that, but that is how we get the $250,000 for step 3. So for step 4, this is the adjustment to fair value for the assets and liabilities, excluding intangible assets and goodwill for Sand. Well, remember the valuation report said everything was the same except for inventory, which was $20,000 higher. And then there was also that statement in the instructions that said there was no changes from January 1st, year 5 to the end of the year, right? So our only adjustment here is to increase inventory for $20,000, which is a debit. For step 5, this relates to intangible assets and whether there's any step up in fair value, and the valuation report did not indicate anything about intangible assets, and nor were there any on the Sand balance sheet, right? So that's going to be 0. So in step 6, we either plug goodwill or we would plug a gain. Now on the right, we have $480,000. So that means we're going to have to plug goodwill for $210,000. That means that they paid more than basically the net identifiable assets of what they acquired, right? And if you remember, in that email regarding goodwill impairment, it said that goodwill was initially recorded at $210,000, and that at the end of the year when they did the impairment assessment, well, there was no impairment, right? So that's how we know that the $210,000 plug to goodwill is still the correct number. So now we're ready to prepare the eliminations column in our consolidated balance sheet, right? And all of this information is going to come from our journal entry for the acquisition method. All right, so our first adjustment is going to be to add $20,000 to inventory for that step up in fair value. Right, so that's where the $20,000 comes from. The next row would be to add goodwill of $210,000, right? That's the goodwill for sand. And then we also need to remove the investment from sand. That's the credit. And since this is an asset account, a credit is a negative number, right? So that's why it's negative $360,000. And then we can move down to common stock, additional paid in capital, and retained earnings, right? And so for sand, that $40,000, the $10,000, and the $200,000, well, since we're debiting those accounts in our 6-step journal entry, right? And basically these equity accounts have a natural credit balance. Well, that's going to be a negative elimination in our column there, right? So that's why you see that basically it's a negative number, because we just need to remove anything related to sand. And when we get to the consolidated column, you'll see that basically consolidated stockholders' equity is just equal to what Coral has, which is $1 million. So our last adjustment here is for non-controlling interest, right? And we present non-controlling interest to get from stockholders' equity of Coral to total equity, right? And we need to present that. And since it's a credit and these non-controlling interest is an equity account, well, a credit is a positive number, right? So that's why we have a positive $120,000. So now that we've layered in all of the elimination entries from our 6-step approach, we now have the consolidated column, right? And you can see that total assets is $1,455,000, and total liabilities and equity is also $1,455,000. So we have a balanced balance sheet. Now, when we get to the end and we have to pull some information to complete the prompt, this is where it will come from. But for now, let's move on to the income statement. So for the income statement, we're going to start with the same process, right? So on the right, we have the exhibit that listed out the unconsolidated year 5 income statements for Coral and Sand. So then on the left, this is the beginning of our consolidated income statement. So just like we did for the balance sheet, we'll add together Coral plus Sand. And that gives us the before eliminations column. And again, it's just the same thing. We've added those two together. So now we have our eliminations column, and this is where we need to factor in anything related to intercompany. And we're also going to have to remove the earnings from investment in sand that Coral has on their income statement there, right? Which is $67,500, right? So we need to eliminate it. Otherwise, we are double counting that share of income. So in the eliminations column, to remove that, we'll just have a negative number here, which is $67,500, right? So in the consolidated, that would be 0. Now let's focus on the intercompany activity, because remember, there was some intercompany activity between Coral and Sand. They had transferred $50,000 of inventory at a 20% markup to Sand, right? So we can see how we get to that transfer price of $60,000, right? So that means that sales and cost of goods sold in the statement would be overstated. So how can we eliminate that intercompany activity? Well, we can reduce sales by debiting sales for $60,000, and then we would credit cost of goods sold to remove the $60,000 that would have been recorded by Sand and Coral when that inventory was transferred, right? So that's how on the credit side, we have a credit to cost of goods sold for $50,000. So that's specific to Coral. And then we'll also remove $10,000 for Sand. But either way, we're just removing $60,000 of sales and cost of goods sold, right? So that's why we can see in the eliminations column, it's negative $60,000 and negative $60,000 for sales and cost of goods sold. The net impact of gross profit is 0, but we need to do that so that we don't overstate sales and cost of goods sold. So now we have the consolidated column, and this is basically Coral plus Sand, and then we eliminated any intercompany activity as well as the equity investment in Sand, right? The earnings from that. So that tells us net income is $303,000, right? But that is for the assumption that 100% of Sand is owned by Coral, but that's not true, right? So we have non-controlling interest. So what we need to do is actually back out the share of net income that relates to non-controlling interest. And that's going to be the 25% times the 90,000, which we already calculated, and that was 22,500. Right, so what we need to add is a row that says net income attributable to non-controlling interest, and that's the 22,500, and then one more row, which is net income attributable to Coral shareholders. And that gets us down to $280,500. Ultimately, that's the same amount as the initial Coral net income, right? So that is how this all comes together, but this is the proper way to show 100% of net income for Coral and Sand and then back out the non-controlling interest to just get to the piece that relates to Coral shareholders, right? So that's the consolidated income statement for year 5 for Coral and its subsidiary. So now that we've prepared the consolidated balance sheet and income statement for Coral and its subsidiaries, now we should be ready to answer the tasks from the simulation, right? So those are all listed on the left, and then on the right, I'll bring up the schedules as needed to attack these tasks, all right? So the first one says, in the December 31 year 5 consolidated financial statements of Coral and its subsidiary, total net sales would be what? So we can see in our schedule that if we just simply added sales for Coral and Sand together, it would be $1,700,000, right? But that includes some intercompany activity, and we figured out that sales was overstated by $60,000. So when we back that out, well, we get consolidated net sales of $1,640,000. So that's the correct answer for that task. Now this next task says, in the December 31 year 5 consolidated financial statements of Coral and its subsidiary, total net income attributable to Coral shareholder would be, right? So it's very important that we understand that it says net income attributable to Coral shareholder, right? So that's not going to be total net income because that includes the piece of non-controlling interest, right? So it's not going to be that $303,000. We need to take the $280,500 that's attributable to just the Coral shareholders, right? So for that task, it's going to be $280,500. So these next few relate to the balance sheet, so that's what I'll bring up, right? So this next task says, in the December 31 year 5 consolidated financial statements of Coral and its subsidiary, total current assets would be what? Right, so if we just took the total current assets from the individual unconsolidated balance sheets, well, before our step up in fair value, you would have said it's $595,000. But remember, we have to increase inventory up to that fair value, which means we had to add in that $20,000. So that actually means that consolidated current assets is $615,000, right? So don't forget about any step up in fair value related to the acquisition. That's a tricky one, but that's where we usually get a difference there, right? So the correct answer for this row is $615,000. The next row says, in the December 31 year 5 consolidated financial statements of Coral and its subsidiary, total retained earnings on the balance sheet would be what? Right? So remember, retained earnings and really just equity, it's just the parent company, right? Not the acquired subsidiary, right? We can see that we eliminated all of the equity, which includes retained earnings for Sand, right? So all we're left with from this consolidated balance sheet for retained earnings is the Coral retained earnings, which is $750,000, right? So that's the correct answer for that row. And then this last row says, in the December 31 year 5 consolidated financial statements of Coral and its subsidiary, total non-controlling interest on the balance sheet would be what? Right? So remember, at the beginning of the year, if it said January 1st year 5, we would have put $100,000, but then we had to factor in the share of net income, which increases non-controlling interest, and then we had to also reduce it for the share of dividends. And that's how we got to $120,000, which is going to be the correct answer for this row. Wow, that was a very, very difficult simulation. That's almost 24 minutes of walking you through how to prepare the consolidated balance sheet and income statement for Coral and its subsidiary. Right? We touched on a lot of topics. A lot of things are difficult here, but hopefully this simulation helped you understand how all of this comes together, right? That's the hardest part, and where most candidates fall short. They understand these individual topics, but they just don't quite understand the big picture. And that's what we tackled here, right? We took our time, and hopefully now you completely understand it. One last thing, I know a lot of candidates like to play with the Excel files to understand how these consolidated financial statements are created. So I've included the Excel file. It's linked in the text explanation of the simulation. So definitely download it, make sure you understand it, and sometimes just playing around in Excel helps you become more familiar with how all this actually rolls up together.